Hi, Mark Kohler here, CPA attorney and senior tax advisor here at TaxSlayer. Now, let's talk about mortgage interest. This is a big topic, great tax write-off strategy, and I want you to be aware of some of the issues as you go to prepare your tax return. Now, let me say this right from the beginning. If you own rental property, investment property, and you have a mortgage involved, that interest is completely tax deductible. There's no limits on that. It's a property for business purposes and the mortgage interest is entirely deductible. But when you go to do your personal return and you're trying to write off the mortgage interest on your personal residence, well, we used to use the itemized deduction strategy for that, right? Well, that's where the changes come into play. So let's go through the 2017 rules and then we can better understand the 2018 rules. It's going to help you make some good decisions on your tax prep for 2017 and money-making decisions in 2018. Now in 2017, we're writing off the mortgage interest on a qualified residence. This is a great thing. We've been doing this for years, and buying a home is a great investment. I want my clients to invest in a home whenever possible. Now I know some of you may live in an urban area where renting is cheaper than buying, and some of you are saving up the money to get in your first home. But the far majority of Americans should be investing in their home, and it's a primary asset of so many of us. Now the interest on this mortgage on the buying a home has always been deductible, and we have loved it. Now there's been some limits. Now here's the rule in 2017. You could deduct all the interest on up to $1 million worth of qualified interest mortgages. Now this is your primary home, qualified residence, sticks and bricks. It could be an RV, it could be a mobile home, a boat. And then you could even deduct the interest on up to $100,000 of refinanced or HELOC or second mortgage interest. So all that was added up and put on an itemized deduction line. And then you again compare it to your standard deduction. And for many years, that was a wonderful way to go. Well, the rules have changed in 2018. Now in 2018, first, bad news. Well, a lot of it's bad news, but the worst news is the HELOC interest, second mortgage interest, is no longer deductible at all. None whatsoever. But for those of you that had a mortgage before on a primary residence acquisition mortgage up to $1 million worth, that interest is still deductible. It's going to get grandfathered in, so that's not going to change. As you buy a new home, any of you out there buy a new home in 2018 until 2023, and then maybe the rule will change again, you can deduct only up to $750,000 of acquisition indebtedness. Not a second mortgage or a refi unless it's on the acquisition indebtedness only. And it's only the interest on up to $750,000 of primary residence acquisition indebtedness. So it really trims back that interest level. Now watch my other video on comparing the itemized deduction to the standard deduction because you're going to add all those up and see where you fall. But this mortgage interest is going to change. Now in summary, luckily, TaxSlayer does a great job for you helping you analyze this. The IRS forms for this to grandfather in old interest and new interest, you don't even want to see it. It's ugly. But TaxSlayer software helps you navigate this tricky equation so that you can maximize your tax deduction. So get all those mortgage statements, get your records together, and make sure you input it into the software so you can get the maximum refund and save some taxes.